Hi, everyone. Thank you for being here and joining us today, and welcome to part one of our two-part Start of Construction webinar. My name is Tori Roessler. I'm a tax attorney in Foley's Washington, D.C. office, and I'm here with both John Eliason and Darin Lowder, and I'll let them introduce themselves.
Hi, everyone. This is John Eliason. We are all actually here in D.C. together, and I am a tax attorney, work a lot with both Tori and Darin, and happy to talk about Start of Construction today.
Hi, Darin Lowder, also here at Foley Lardner. In fact, I joined the team here from another firm earlier this year and thrilled to be here. I'm an energy lawyer working with sponsors, developers, and typically lenders, heavily on the solar space. So very excited to talk about this today.
Did someone pay you to say that about having?
Absolutely.
Okay, wonderful.
So we're just going to jump right into this. We understand that you all generally have a pretty broad range of knowledge about the relevant tax code provisions and the general practices involving tax credits. So we just plan on doing a quick overview, and then we're going to quickly dive into the weeds with some interesting hypotheticals at the end. So as many of you know, several years ago, the law changed, and now the amount of the tax credit is based on when construction begins, rather than the date that the project was placed into service. And now the tax credit is subject to a phase down, which we'll discuss in more detail later. However, the wrinkle here and why we're here today for this webinar is the statute does not tell us what it means to begin construction. So, as previously mentioned, the ITC is now subject to a phase down. And since wind has kind of had to deal with this for a couple years now, this presentation mainly focuses on the ITC. And the chart, you'll see the chart on the screen, that the ITC is subject to a phase down from the current 30% down to only 10% in a few years. So in the past several years, there have been many IRS notices published regarding this beginning construction issue. You'll see that there have been 7 notices published relating to the PTC, each of which kind of help formulate the rule and provide the necessary extensions, and there have just been 2 notices for the ITC. The first notice for the ITC, Notice 2018-59, essentially just picked up where the PTC IRS notices left off with formulating the rules. So that notice uses the information that was already given in the prior notices provided for the PTC and just kind of picks up there. And then you'll see the latest guidance, Notice 2019-43, just sets forth another permitted exception relating to both the PTC and the ITC.
And this is Darin. I'd just note that a lot of these similar issues arose under the 1603 grant program with the Treasury Department, but since this is the IRS, hence the notices, we had other guidance under the 1603, but similar issue a number of years ago that is being clarified now.
Okay, so this is John. So under the notice 2018-59, there are 2 methods available to establish the beginning of construction. The physical work test, which is the one we're going to talk about today, and then the 5% safe harbor, which we're going to talk about in a few weeks in a separate webinar. So be sure to dial back in for that one. Under the physical work test, what the IRS is looking for is they're looking for the year in which physical work of a significant nature begins. As provided by the guidance, the nature of the work is what's important, not the amount of the work or the cost of the work. And that nature of that work is it's really kind of based on just a view as whether the work's material. And basically on-site work, work at your construction site or off-site work is equally satisfies the physical work test. We've got some stuff on the slides about the 5% safe harbor, really just for completeness, but as I said, that's the subject to the next webinar, so we're not going to be talking about that today. Okay. The guidance doesn't provide a lot of information about what it means to start construction, but it does certainly tells you what preliminary activities won't count. We've put the list here. This is a non-exclusive list, but typically people kind of look at this and say, okay, let's make sure that we're not doing these or anything similar. Just a couple things to kind of point out, because we certainly heard this from clients. You're building a utility scale solar project and you want to go out there and you want to compact the soil before you get started. Compacting the soil would be viewed as preliminary site work, and that's not gonna satisfy start of construction. Another one that people kind of look at is clearing the trees from the site, or doing kind of the design activities and things like that. All those are preliminary.
So, John, I guess a couple of questions. This is Darin. So the first question, just because something may be a qualifying cost for the purposes of the ITC, this is a completely different analysis. That may be part of the capital cost of a project. It's allowable as basis, but it's a different question. So some of the arranging, financing, the design is an acceptable construction cost, but it's not a construction activity for physical work.
Yeah, that's right. Yeah, so all the costs associated with planning, researching, compacting the soil, those will all end up being capitalized in your basis, and those will be taken into account in figuring out what your ITC amount ultimately is, but they're just not viewed as construction activities. Construction activities that the IRS is basically looking for is actually, if you're on site, like starting to put in piles or starting to actually build the asset. And what's important there is that it's only you have to start at construction of things that are going to be treated as ITC eligible at the end of the day. So roads, for example, don't seem like that's something that should be ITC eligible, but roads are service roads, I should say, are necessary for the operation of the asset, or the operation of a solar facility. So starting roads demonstrates start of construction.
So those are roads that will be permanent. Is that construction access? Is that a different analysis? The roads are used just for construction.
Yeah, these should be permanent. These should be the permanent roads. So these would be kind of like the and I know that on a solar site there's not a whole lot of roads put in, but think like these are like kind of the gravel service roads that might be in between the different blocks.
So one last question before we move on this one. Seems like there could be a fine line between site preparation and digging a foundation for a concrete pad for equipment. How is that evaluated?
Yeah, I mean it really.
You're moving dirt with a bulldozer in both cases, right? But it's different intent.
I think that on this, depending on how much you're doing, how much work you're doing, you probably want to do a little bit more than just move dirt around. I mean, if you're actually kind of improving the land in a way, like by adding kind of like a gravel underlayer for a pad, or kind of doing that on a road, or something like that. That's the kind of work that you're going to be able to feel pretty comfortable that you've started construction, as opposed to just moving dirt. The risk is that just moving dirt could be viewed as just site prep in advance of actual construction.
Thanks. All right, continuity. Tori.
So I know we just talked about the importance of beginning construction and suggestions of what to do and what not to do, the preliminary activities we just discussed, but you're not totally in the clear once you have simply started construction. And so once you start construction under either the physical work test or the 5% safe harbor, there's a continuity requirement. And for the physical work test specifically, you'll need to continue physical work of a significant nature, as we just discussed the past 10 or so minutes. The continuity requirement under the 5% safe harbor is slightly different, but we'll get there next month.
All right. terms of excusable delays, this is, I think, an interesting clarification that was not always clear in previous guidance. There are some specific excusable disruptions allowed. So in other words, if these things occur and stop your continuity or kind of break the chain for a time, they don't stop the analysis. They don't prevent you from having continuous construction during that period. So some examples, and these, if you look at these, they look a lot like force majeure types of events. So delays due to severe weather conditions. We had a client that had severe flooding in the south with excessive rains for months that put the project behind schedule. So that can occur, but that wouldn't necessarily stop the continuity analysis. Natural disasters, labor stoppages, permits, licenses, governmental intervention, things related to interconnection. So this actually is very comforting, a lot of these items, for lenders and financing parties that are looking at the risks of not meeting this requirement and what could possibly throw them off. So if the developer is continuing according to schedule and they're continuing to move forward on those things they can control, then you're probably in pretty good shape generally. And that brings us to our first safe harbor.
Yeah, so the test that we've talked about, especially when you start thinking about the continuity continuous efforts, it's all based on facts and circumstances. It's subjective as to whether or not you satisfy it. People that finance solar projects really hate subjective tests because there's uncertainty as to whether or not you're actually going to be qualified for the credit you're expecting. So thankfully, there's actually a safe harbor with respect to demonstrating continuous construction efforts, and that safe harbor provides that as long as you're placing the asset in service within 4 years, the end of the fourth year in which, or the end of the, sorry, it's kind of a hard way to explain it. Yeah, so no more than 4 years after the year during which construction began, then it's just the continuity requirement is deemed satisfied. So we have an example here. What you'll see is that if you begin construction in 2019, as long as you place the asset in service by the end of 2023, you don't have to prove up the fact that you've continually done construction on that asset. It'll just be deemed satisfied. And when you think about solar, that basically tells us is that if we're talking about 2019 starts of construction, that's really the only thing you need to worry about, because to qualify for anything more than a 10% ITC, you have to have that asset placed in service by 2024 anyway. If you kind of go back to think about like the slides that Tori was talking about. And by the way, we should add is that these slides will all be available following the presentation. But because of the way that the ITC kind of goes from 30 down to 10, and then it's 10 for anything beginning in 2024 and later, the continuity safe harbor really just kind of takes care of that question for solar.
And so, John, this timing, whether it's January 1st or January 31st or December 31st in 2019, the safe harbor date is December 31st, 2023 in that case. It's a calendar year trigger.
That's correct. That's correct.
All right.
So we just discussed the ITC phase down, and due to this phase down, developers are planning on completing work today in 2019 to qualify future projects for the current 30% tax credit. And we're getting so many start of construction questions just ending the year, almost done 2019, so they're planning on completing all this work today. And you'll see from the chart on the slides that the tax credit percentage drops each year, if not grandfathered this year.
Yeah, so as developers are trying to look to qualify projects, future projects by starting construction in 2019, there's really, the strategy really depends on whether or not you have site control, or whether or not the developer has site control. if you have site control and you can actually get out there and start doing construction this year on site, that's preferable because it's easy enough to point to that the work is actually there, right? You can take pictures of it. You can go visit the site and ensure it's there. So what we see there is typically we see people focusing on starting construction of service roads or starting to drive piles in advance of the installation of racks. And we'll talk a little bit later about kind of like, what's a sufficient number of those. That's not really an IRS rule. That's really kind of more something that the financing parties will care about. But as you see here, it's certainly that the on-site physical work that you can kind of point to on-site is preferable to the off-site.
So this would be where you're fairly advanced in the development stage. You have a site selected, you have locations, you have on-site work. The next example would be earlier stage, right?
Right. So if you don't have site control, then you're really left to performing off-site work. Now, off-site work is talked about in the notice 2018-59 as qualifying, and it's either work that's performed by the taxpayer off-site or it's more typically it's relying on a third-party manufacturer. That's known in the guidance as the look-through rule. So we're basically looking through the activities of another person to satisfy start of construction on our project. So when you see that, it's usually the construction of equipment, and to qualify for that look-through rule, it has to be pursuant to a binding written contract. And we have up here on our slide the things that you need to satisfy for it to be a binding written contract. Obviously, it must be in writing. We've actually got that question before, not from anyone who's dialed in, I'm sure. Second of all, you've got to have that contract executed before construction begins. And that's one that sometimes can throw people off because they talk a lot about to a manufacturer, okay, we want to get our transformer started, and the manufacturer starts, but the contract's not signed yet. You can't count that work that's occurring before that contract's signed. Another one, it's got to be enforceable under local law against the buyers. It really should be against both parties. It's a real contract to buy real things. It's not an option. It's not window dressing. You've got to identify what you're buying and kind of what you're paying for those items. And then you can have some damage limitations, but you got to make sure that you're always going to be on the hook for at least 5% of the total contract price.
And I would point out that these major agreements would really need to be executed and in place prior to closing the financing, because that's going to be an important part of the diligence process and the analysis that these are in fact binding.
Yeah, so in the case of manufactured equipment, the equipment, the rule tells us the equipment must not be held in existing inventory or normally held in inventory by vendors. So this cannot be a contract to buy solar panels. It can't be a contract to buy off-the-shelf components. It's got to be something that is basically being built. It's being ordered and built for the taxpayer.
So one question we get all the time is people asking about transferring equipment and or projects after construction has already started on this equipment. So thankfully, the guidance provides some pretty helpful rules here and some flexibility with those rules as well. And you'll see on this chart, which I find this chart to be incredibly helpful, the one on the screen. On the first action, you can move ITC eligible equipment intended for Project A to Project B. So you do not need to have a specific project identified at the time the equipment is purchased. You can move ITC eligible equipment from Project A to Project B and create eligibility for this Project B through the act of this transfer. So that's incredibly helpful. The second action, you can transfer ITC eligible equipment to an affiliate. So for an LLC, it must have at least 20% common ownership, and this way you can maintain eligibility for this ITC eligible equipment. Moving down to the third action, you can sell the ITC eligible equipment with project assets. This includes things like site control, interconnection, a PPA, et cetera, to maintain eligibility of this equipment. So the pitfall here is you cannot simply sell ITC eligible equipment to an unaffiliated third party. That does not fit into one of these first three categories, and that will cause this ITC eligible equipment to become ineligible for the ITC.
Yeah, so one of the things that we saw a lot in kind of the 1603 days, because these rules, as Darin had said originally, were really kind of came out of there, is a situation where somebody has a bunch of ITC eligible equipment that they started construction on, but they really never intended to actually develop a project. They really want to be able to sell that equipment to somebody else.
At a markup.
At a markup, yeah, because it's golden equipment. I mean, this is good stuff. So the problem is that you're going to fall afoul of this last rule. So the structure that people came up with was, hey, and we were kind of part of this too, I should say, is that, hey, let's start a partnership in which the person who owns the equipment has a more than 20% ownership interest in that partnership, so thus it's an affiliate, and the majority partner, the 79% partner, is the one who maybe kind of brings the kind of the uneligible part of the project, right? The project, the interconnections, whatever, to that partnership, and then that partnership then develops the project. With the idea is that, okay, I'm transferring equipment, ITC eligible equipment, to an affiliate because I'm kind of getting over that ownership threshold. Now, if you own the equipment, you have no intent of really wanting to design a project. You would say, hey, well, how about the day after I transfer it, I give my 79% partner the ability to call my interest, right? They can buy me out. We can have it at fair market value, or maybe even less than fair market value, just to make sure it's exercised. Or maybe I have a put right where I can just put my interest to them. So when you have an arrangement like that for tax purposes, that's going to be viewed as a disguised sale, and it's going to be it's just not going to be respected as a true partnership. So you're going to lose eligibility with a structure like that. The way that you kind of manage this, and this is kind of what folks were doing in the 1603 days, is that you can certainly have that call right, but make sure that it's out past the period where a disguised sale is presumed. So the rules on disguised sale will tell you that has to be that someone can't have that call happening kind of within 2 years of when you started that partnership. Because if you do have it, it'll just be presumed that it's a disguised sale, that you have to kind of overcome that presumption. We tell people that it's a little safer to kind of have a right like that at like the 3-year mark, just to make sure there's no question that you're kind of doing something that's not going to get respected.
So, John, that's a great segue. We've been talking about the IRS rules so far. I think we're going to talk about the distinction between those and what is in practice.
Yeah, exactly. So it kind of looks like a target, doesn't it? I know you were going for the red light, green light, Darin. So the IRS tells us what the rules are, right? We've gone over those. These are the rules that the IRS is going to look at, and the guidance you need to kind of determine whether or not you're going to have ITC eligible property, and kind of when you've started construction. Now, tax equity has an interpretation of those rules, which is more conservative. And it really kind of goes to this idea that more is more, right? If you're actually being audited by the IRS, wouldn't it be better to be able to demonstrate that you've done a ton of stuff instead of the bare minimum under the notice? So we certainly get that, and we have just some thoughts about kind of what the IRS rule is and the tax equities interpretation. Tori?
So continuing on our bullseye concept, we're going to go through some of the IRS rules we've been discussing so far versus what we commonly hear in tax equity. So the first IRS rule that as long as the work is of a significant nature, no minimum amount is required.
Yeah, so that rule is right in the notice. It's basically drafted just like we've got here. What we hear from tax equity, can we put that up? Is that, sorry, Darin wasn't paying attention. When we put up the tax equity interpretation is they want to say, oh, well, we'd like to get us maybe start on at least 10% of the roads and pilings, right? You don't have to finish them, but at least start on at least 10%. Another one we hear is we'd like to see you spend roughly 1% of total ITC eligible cost. And the reason that they're saying that is they really want to kind of get to make sure that this is a material amount of work, even though the notice would suggest to you that even starting on, 1% of the piles should do it because you need those piles to actually as part of the construction of your asset.
So second rule is we have the IRS rule that John discussed a couple of slides ago that components manufactured under a binding written contract must not be held in inventory or regularly held in inventory.
Yeah, so for this one, you hear this a lot that, this must be a custom piece of equipment. And there's a strong preference that custom piece of equipment must be customized for the particular site. In other words, some kind of site-specific design. We've also heard that, we really want to see it to be a transformer. Now, the reason tax equity is focusing on custom equipment and transformers is because there's an example in the notice that talks about a custom design transformer as satisfying the rule. But if you really look at what the inventory rule is, it doesn't really talk about custom. It just talks about it not typically being held in inventory. I mean, maybe you get to the same place, but I feel like here's where tax equity is really kind of raising the bar as to what the requirement is.
So moving along, we have the IRS rule we discussed earlier that work performed by others must be pursuant to a binding written contract that is entered into prior to the manufacture, construction, or production of any components.
Yeah, so this is one the tax equity certainly looks at, reviews that binding written contract, but then there's a concern about any kind of modifications of that contract after it's executed. And the risk that tax equity is concerned about there is that they don't want that original binding contract to be viewed as terminated and replaced with a new contract, and the old equipment basically terminated and replaced with new equipment. So you've got to be really careful about any types of changes. My preference always when advising developers here is that, hey, if we can do it with a new contract, with some new piece of equipment or some kind of new component to the transformer, if it's a transformer strategy, as opposed to actually amending the existing contract, let's do that.
So finally, we have the IRS rule regarding the continuity safe harbor, which basically suggests that I could start construction on equipment, set it aside, kind of forget about it, as long as the 4-year safe harbor is satisfied.
Yeah, this is a very common money-saving strategy, right? Is that, hey, I'm going to order my transformer, but I'm going to have multiple payment milestones, and my first payment milestone is $3,000 to kind of start bending steel for the conservator tank or something. Tax equity's preference, strong preference, is that, hey, you should be finishing that transformer in the ordinary course, that equipment in the ordinary course that you're ordering. You shouldn't start it and then put it aside for a couple of years and finish it, even though that preference is really it's in complete opposite of what the IRS is telling you and what the purpose of the continuity safe harbor is that, hey, as long as you're placed in service, within that 4-year period, you're fine. There's other ones too, and maybe I should have mentioned on the phone, as I represent a lot of tax equity investors, so I won't say that, I'm not disparaging tax equity investors, and these things really are, their interpretation really does go to this idea is that tax equity, they want the project to qualify for the ITC that they're counting on. I mean, everyone's really interests are aligned there, so they will really want to make sure that they're clearly over the line.
That's actually a great segue to the lender considerations. So the tax equity has preferences. Lender issues and concerns over safe harbor actually starts by taking some comfort from the tax equity interpretations that John and Tori just walked through. So those requirements, those interpretations provide a lot of comfort to the lenders as well, that you're on the right side of the line. The other issue that the lenders are going to do a lot of diligence on chain of title and history of the safe harbor equipment. when it came to be, what the original contracts were, if those had been transferred at any point, how the project entities came about, and whether they've been transferred or under the same control of the same developer since formation, and then the status of those binding written contracts. Same thing, have they been transferred? Have there been efforts made to amend those? Heavy reliance on cash diversion guarantees and indemnities provided by the sponsor, this is where the sponsor balance sheet becomes important. And in this point, this is all under kind of back leverage, construction, tax equity, bridge loan transactions. And then there's some issues that probably a discussion for another day, things like recapture and insurance versus sponsor balance sheet guarantees. I think the preference at this stage is really on the balance sheet. I think we had scheduled this for 30 minutes. We did have a few questions, and we have some scenarios that we're going to go through for just a few minutes. If folks want to hang on for a little longer, we can go through these fairly quickly.
Yeah, and I guess at this point we'll also kind of mention, and my apologies for failing to mention that at the beginning, is that Foley is sending quite a few people out to SPI. Both Darin and I will be out there, and welcome you. That if you want to shoot us an email and try to get together out in Salt Lake, I'd be happy to sit down and kind of go through some specific scenarios for you. It would be great to meet as well. All right.
Yeah. Great. All right, so we have a few hypotheticals.
All right, so we promised some interesting hypotheticals, so here they are. So the first one...
What we think is interesting.
Yeah, I know. Everyone will think it's interesting. So the developer has 1 gigawatt of project with no site control and wants each project to qualify under the physical work test.
Oh, is that a timer? Yeah, it's a very common hypothetical, right? It's like, hey, we've got this huge pipeline, but we don't quite have site control, but we want to make sure that they're all 30% ITC. So what we typically see people do is we see people setting up a wholly owned LLC, like a procurement LLC, to enter into binding contracts to obtain it's usually transformers, so here custom designed transformers, and I know I'm kind of falling right into the tax equities interpretation, but my understanding of transformers is that they can be custom, but they can also be used at multiple sites in kind of custom formats. I think that works here. But then kind of once the developer's done that, then the developer plans on assigning those transformers to various project codes at a later date. So once they've kind of obtained site control and they've actually kind of a little bit more forward on their project itself, is to just drop that equipment into that project code and qualify that project for the 30% ITC.
All right, hypothetical number 2.
All right, another question we get a lot. What if a developer begins physical work of a significant nature on a project in 2019, including work like road construction and pile driving, but after this work begins, a hurricane comes in and destroys all of the work that was completed? And now the developer wants to know, can they still rely on this work?
So I've been listening to John closely here, so I'm going to jump in on this one. I'm going to say a very complicated answer: no. I guess there's probably a little more we can explain there. So basically, they should start on-site work again in 2019 if possible, and pair that with 2019 equipment, or sell the project to somebody else that has 2019 qualifying equipment. Again, to John's point that he made earlier, there has to be the work that you've started has to be work that actually ends up in the project.
Yeah, we're actually, if you dial in, if we haven't bored you to tears and you actually dial into the second half of this, we're going to have a slightly different answer here with respect to actually spending money. But if you're trying to establish your qualification through the use of physical work, you've got to be able to point to something in your project that you actually started on in the year you said you started on it. So that's really kind of what this rule goes to.
All right, number 3.
Our last typo.
Our last one.
Yeah. All right, so here we have a developer that decides to buy a project from a third-party seller, and the seller completed minimal road work back in 2015. The developer, as the buyer, wants to restart the clock to get the full benefit of the continuity safe harbor and complete other physical work on the project, and they want to know if this is okay.
Yeah, so restarting the clock, we get this a lot, right? People started too early. This actually came up a lot more in wind, I think, because in wind, Congress kept moving the goalposts as to when you had to start construction to qualify, and so people were like, oh, we want that full benefit of that 4-year safe harbor, but these guys started back in 2013. So the answer there, it's actually the easy answer is, well, if you can carve that out of what you're buying, don't buy it. Right, so maybe that's easier in wind, where you can say, okay, we're not going to buy those 4 turbine foundations. We're just going to kind of, leave those with you, and we're going to buy everything else. If that doesn't work, or I guess it's probably a little harder on the solar side.
So that the idea is you never owned that. If you purchase it without those assets, that was not part of the project that you purchased. It wasn't the equipment that you own.
That is exactly, yeah, that's exactly right. Yeah, so we actually have a question on this too, but so this is kind of like the other one. It's like, well, what if we do buy it? Can we just tear it up and start over again? And I don't recommend that strategy, because I think that in some ways it's really coming up with kind of an unintentional way of restarting the clock that IRS didn't intend. But one thing that's kind of interesting about that is that in the preliminary activities that aren't viewed as construction, it includes clearing the site, including removing solar panels and other equipment that's not going to be in the project. So I'm thinking, well, if you've changed the entire design and you can point to some reason that you did it, other than simply that you want to start the continuity safe harbor clock again, I think you can probably bulldoze it.
That's one of the specific list items.
Yeah. The problem with all of the kind of continuity, safe harbor, physical work and everything is that you don't ask the IRS in advance to look at this. So this is all determined after you place the asset in service. So that's kind of where it gets a little risky, and where you're kind of looking at saying, okay, well, did I do it or did I not do it? Unlike a place where you could have someone go out there and look at it. So what people do is they end up having, they talk to tax lawyers, they have engineers look at things, but you're not getting kind of input from the IRS. A lot of people don't like to talk to the IRS, so I guess that's not a bad thing either. But yeah, so we do have a couple of questions from folks. We have a question about starting roads and kind of what that means, right? In our view of this, I think this is kind of accepted by others, is that you certainly don't have to finish the roads, but you should be doing more than just bulldozing the path that the roads are going to go on, because that could be viewed as just prepping the site. But if you're like putting kind of like underlayers, or starting to put crushed rock down, or even sand, if you're basically adding to the property, I think you're going to be okay, rather than just kind of moving dirt around. We have another question about. Actually, did we cover this one? Okay.
Yeah.
Let's see. We have a question about whether tax equity investors require the developer to engage a particular expert, like an independent engineer or an accountant, to determine kind of what work was performed and whether it was going to be treated as ITC eligible. We don't see usually a specific person required, but you certainly see independent verification that you'll typically see an IE report, maybe doing a site visit, taking pictures, certifying kind of what occurred and took place on site, and then if it's anything that's at all questionable, like hey, we put the fence in, should that count? So the guidance will tell you fences don't count. So we'll never suggest to any client that they should be installing a fence and point to that as demonstrating start of construction. Although I think it's a pretty good argument that a fence, if it's required, if you're required to have a fence to actually obtain your permit, that the fence itself should really be viewed as ITC eligible. But that's for a whole nother day. Okay, so we are kind of at our stop point. We will, questions keep coming in, we'll respond to those answers offline, and these materials will also be available. I'm not sure how we get those to you, but we'll figure that out.